Very good evening to everyone. In previous class, we have discussed about investment objectives and the different types of strategy on the investment objectives. Based on the investment objective and strategy, we have just started with the income as a main investment objective, the growth as a second objectives, and the capital preservation as a third objective. Now, by taking into this investment objectives, we have classified multiple role of investment plan and this diversification of this investment based on certain objectives and how the strategies are going to helpful for investment to meet with the objectives. So you can see this slide here, activeness and passiveness, diversification of fund, capital appreciation, income generation, and capital preservation. Now, important concepts of this mutual fund, it also classify based on the unit or in form of a face value, in form of a unit capital, and many other. When we talks about in form of different classification of investment objective, here we can see about the investment in that an investor makes a scheme or is translated into a certain number of units in the scheme, and at the same time investor scheme is issued unit for every type of scheme. Then when we classify for face value, every unit has a face value rupees 10, and that is relevant for accounting perspective. At the same time you have a unit capital, so it is a number of units which have been multiplied with the face value. So this is what they are clearly investment objectives stand with the strategy and how it is classified, in what terms it is classified, different avenue of this investment, how it will yield return. So we are taken the first as an income as one of the investment objective. Then we have gone through for the second as a growth of this investment plan, and third capital preservation. So every accumulated money in form of capital and how this is diversified. So you can see this slide investment based on 1, 2, 3, 4, 5 and various other form of objectives have been fulfilled. So the next slide talks about the fourth point here, balanced or hybrid. When it comes for hybrid, already have explained in different form. They are the combination. One of the objective also talks about the hybrid with the a combination or combining of growth, income, preservation strategy to achieve mix of risk and return. So normally a balanced or the hybrid, it go for combination of different types of investments, especially the combination of the growth, income, preservation strategy, and it just go for how whether you maximize the risk or minimize the risk. So maximize the return, minimize the risk, whether you maximize the profit, minimize the risk, or whether you increase your risk or minimize the risk. So this is classified based on the balance or hybrid strategies. Now some of the strategy based on the balance and hybrid, number one strategy is to allocate investment between stocks for growth and bond for income and stability. Now taking this point, I can explain you about how do you allocate a stock. There are many people invest for long run for the growth purpose. At the same time, they invest in form of bond also to see the tax purpose or to see any other investment purpose. So you have a classification. When you go for raising of your debt, automatically cost of capital will come down. At the same time, company valuation will go high. At the same time, you can see company market value or equity share value also goes up when you go for increasing debt. So they diversify and balance or hybrid combination, and allocation of investment also made based on that type of stocks or bond which will yield one income and there is a stability. So bond go for fixed income with the stability income and without any type of risk. So it use one of the strategy talks about use dynamic asset allocation to adjust the market condition, a different allocation of asset in different manner, and that is adjusted in the market condition too. And the third one, it focus on a moderate risk, catering to investor with the balanced risk appetite. Now when they go for risk appetite, they will see that you might be studied about in previous class about how a investment pattern should be debt and equity, the ratio of debt and equity, the combination of debt and equity ratio based on what classification. So many of the company they never entertain too much debt, but equity is a main source of income they see. Why? Because when it's come for debt, you need to repay some kind of interest, but when it's come for in form of equity, I say the dividend is given in form of return, and when it's come for debt, you need to pay interest, which is fixed. So which is a more profitable, more beneficial, and which has a high risk or less risk? So that is classified. So focus on the moderate risk, catering to investor with the balanced risk appetite. Example, you have a hybrid balance fund, target date funds, and asset allocation funds. Then coming to the third slide here, one of the benefit from investment objectives and the strategy is the tax efficiency. So the main objective, maximize tax liability while earning return. So many of the company, they just go for classification about how to maximize the income, how to reduce the cost. So I said there are two types of variables here. One, when company go for increasing the debt, automatically it has a counter effect on its cost of capital of the company. The cost of capital might decrease when you go for increasing debt, number one. At the same time, you have another side. When you go for increasing of your debt, it has impact on the cost of capital. At the meanwhile, it go for increase in equity value, increase in the market value. Okay, increase in the market value of the firm. Now, uh, that is one way. Another way, the same when you go for increasing debt, what you can see the objective here, the tax liability. While earning the return, you will pay whatever tax and get tax rebate or kind of tax relief based on your interest what you pay on the debt. So the strategies here, invest in tax exempt security like a municipal bond, tax exempt securities. There are many people invest in the tax benefit sake and tax exempt security. They invest, example, they get a municipal bond. Use tax managed strategies such as harvesting capital losses to offset the gain. So one side you go for capital gain, other side to offset that, you just show this capital gain in form of investment, and you take kind of a benefit from the government in the name of tax free. So tax is managed, one of the best use of strategy. Then focus on the qualified dividend paying stocks. You focus on the some of the qualified paying stocks like the maturity date, exactly with what how much dividend might be with the quarterly or half yearly or annual basis, based on what qualified dividend you get, whether it is more than your investment return or the kind of a debt or other security. So this is classified under tax efficiency. So investment made under tax efficiency. And one of the strategy talks about tax exemption. You invest in tax exemption municipal bond or any other strategy is applied for increasing your gain or offsetting your gain. Then example is given tax-free bond funds. There are example is given municipal fund are exempted from the tax, so they are tax-free bond funds, municipal funds, and the tax manager equity funds. The sixth point here, we'll get into the sixth one, but before that, we'll just go through for investment objective, how I have said about investment objective and its strategy. So here, one of the classification of this investment strategy based on growth, what I said, capital preservation and the income, or in form of preservation or income. Now, why this funding is required, and what is the purpose of this investment plan or investment objective? Every investor to meet his day-to-day routine need or to get the safer side of his investment, and he just search that exactly where I can invest, which fund is more suitable for me, which is more profitable for me, and how long I can invest, what is my priority of the funding. And when it's come for a common question here, you can see here there is a funding priority. A common person has a funding priority here, where exactly he can invest. So funding priority, normally living we say. as a common person, initially we talks about the living, then you have a lifestyle, then you have emergency funds, then you have a legacy. Now, if you see again the investment objective, growth, long-term growth of capital, and every investor would like to invest in the long-term growth capital. So he invests for future forecasting, like how I get a return in what form. So growth, I never think about the growth in the short run. I always think about how growth can be made and what kind of profit can be attracted in the long run. So this is how it classified. Then at the same time, under long-term growth capital, it also talks about the income, which is more suitable for me to yield the return or yield income. It is whether it is a current income or whether it is my long-term perception on the growth of this income or conservative of capital. So by taking this four funding priority, I may take living as my priority, my lifestyle as a priority, emergency as a priority, or legacy as a priority. Legacy in form of a family, in form of day-to-day need, in form of my pursuedness based on the capital structure. So people just invest when it's come from mutual fund. They just calculate like I started my investing in 25th year, and when I get retired after my 35-year service, what is take home of this investment and getting return. So many of the people they classify based on the inflation rate. So today's investment, what you do, and future what you get return, and that time what is inflation after 25 to 35 years, whether it is fruitful or profitable, that is also classified. So today's inflation, today's investment rate, today's interest rate, and what you pay as an extra tax for the government, and the future inflation, future income, and what is expected in the future return, whether that has a balance. So everything you need to plan in advance. So keeping this four thing has a priority. So I have said that about living. It might be the standard of living of a people, living in the name of pursuiness of individual today and tomorrow, the lifestyle based kind of lifestyle, the emergency, especially when it's come for emergency. Today funds allocation, not only in form of investment in form of your health. So many people invest types of health related funds. So where hospitalized, when it's come for this kind of a insurance products you have, where just getting the product, making yourself safe as a priority. So rather than getting lost in the future, for the safer side, you just go for giving some money in the name of health insurance. You go for start investing in this kind of fund. It might be annually or half yearly, depend again how this claim settlement based on the emergency fund. So based on this objective, people just go for giving the priority might be many, but after that these are the main priority. Living, lifestyle, emergency, legacy become the main priority here. Based on that, you might be seeing the people just go for, when it's come for investment objectives under mutual fund, a long-term capital gain or long-term capital preservation or current income. Many people just go for investment for today and just expect within somewhat days that how much return they can expect. Then when it's come for preservation of an income, they classify that how a funding priority is required to look into all this diagram. You can see this pyramid, how a living or lifestyle can change based on different types of a investment avenues. So, and you might be seeing that there are so many people just go for investing under one particular format of investment plan, where they should know that there are category like from this age to this age, have just go for investment one certain amount, and after certain promotion I just go for doubling of this investment, and after that what return can be expected. So basic, I said that in the previous classes, the base price starting of investment should be 500 rupees, and you can go for investing any number of amount where you get a return without any kind of a risk. So this is the funding priority what I've been shown in this pyramid diagram. So the next one is about speculation in the high growth. The sixth one of the investment objective and the strategy, investment objective and the strategies. A speculation in the high growth. Objective of speculation will be achieve exceptionally high return, often with high risk. Normally, the main speculation objective will be achieving exceptional high returns. So high return, often with the high risk. This is what you might be seen investing in various avenue. But speculation, I just invest based on future speculative point of view, like that tomorrow my investment might gain, tomorrow my investment will diversify, tomorrow my investment will get double or get return high dividend or high return, though even have a high risk. But one speculation, I just look into future perspective, how much investment today based on the future inflation rate and how much return can be expected. Then you have a strategy and a speculation in the high growth here. Invest in the volatile or high growth assets like small cap stocks, emerging market, and derivatives. Derivative I said about hedging or in case of swap or many other form. So people just go for investing based on speculative. So future option swap. Um, you might be seen in the previous class I said about the derivatives, about the future options, the swap option, right? Based on the different types of speculation, I just go for the investing. Then employ strategy like leveraging or short selling. So you have a short selling with a short span of time. You leverage with the debt and equity, or the leveraging is a one form of financial option for you to invest in the market, but that leveraging has to offset with the risk return profile. Then one of the strategy talks about suitable only for investor with a high risk tolerance. So some investments are purely based on the risk return profile, which are very much suitable for the investor to tolerate your future return and at the same time meet with the risk profile or risk tolerance. So speculation with the high growth. Example given emerging market funds or sector specific funds. Sector specific fund, today's market, if I see, the sectoral funds will be technology, AI, artificial intelligence, then biochemistry, bio-related, biotechnology related, or you go for solar related or green energy related. These are the sectoral specific funds where investments can be seen, and one speculation where it talks about how investments and return are expected in the future days. Then leverage funds already said about kind of a financial funds which has been compromise in a different types of market and just wait for the long-term return. Then the seventh one, the inflation protection. This is very much needed. Nobody knows about the market index based on the speculation. We just predict that this might be the future rate of return or rate of risk. So inflation, just to protect your investment to the safer side or to reduce your cost or to reduce your risk, this inflation protection fund can be, the investment can be based on the protection fund. So there are many people, they just go for investing in this pattern. So objective, preserve the purchasing power of investment by providing return that outpaces the inflation. So which investment can protect you from the future inflation. So that type of purchasing power of investments will enable you to go for investing and to meet with the future inflation. So strategies here: invest in asset like a treasury inflation, protected security, what we call tips, real estate or commodity market. So one of the strategy of inflation protection. So doesn't matter what price you buy now, but based on inflation, market value also will go high when it's come for treasury or real estate or any type of commodity market. Then it includes stocks or mutual fund that target sector benefit from inflationary environment. So there are many stocks or mutual funds where it will offset the inflation. So you have a different types of a funds which can offset the inflation. So you can predict today's investment based on the future inflation. So the investments made today's rate, today's per capita income is diversified in various avenue, and based on today's inflation, I can invest today based on the future inflation, and which can cut down the cost, which can protect your security in form of for investment. So especially people who just go for inflation protection, this kind of fund. So real estate or commodity market or treasury inflated kind of protected securities. So example is here inflation protected bond funds, commodity funds, real estate funds. So there are funds where you can invest in. And and I have said about when it's come for the last point, it is a social response investing, SRI what we call, and environmental, social, and the governance, what we call ESG. And objective of this fund will be investing in social responsible environmental concept, where achieve financial goal while supporting ethical, sustainable, social responsible practices. Then invest in company or sector aligned with ESG criteria. Avoid industry like tobacco, weapon, fossil fuels. Then balance ethical consideration with the performance metrics. So example ESG, I said about environmental, social, governance focused funds. Then impact investing funds, sustainable. And I can tell you future all this type of investment you can see in the market, where environmental protected, eco-friendly funds, or solar energy related funds, or green environmental related, or bio or technology, AI related, all this covers under social response investing. And this can be seen one of the criteria where people just investing in form of different fund which is focused on the different impact. So thank you all remaining. We'll see in next class.